Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover all angles of real estate, from interest rates to the economy to what's happening in Washington, anything that affects you and your real estate decisions. Obviously, we do talk about things on a national perspective, but we will break things down onto a more regional level, as in your major metropolitan areas. I'm actually here in the Washington, D.C. metro area, so I can give you some insights as to what's taking place here. And we want to dive deeper always into the numbers, the economic reports that come out, what the Federal Reserve is doing. It's interesting because most of the information that's put out there would lead you to believe that things are on the up and up. But really, there are no underlying solid foundation for these things. It doesn't make any sense. Like, basically, we have more and more people coming out of college that can't find jobs, that are living in their parents' basements, that the real estate gurus are claiming that they're the next, people that should be buying homes. They're the next wave to bring the real estate market up. We have the stock market at all-time highs. And who's really investing in those markets? It's not the average Joe. It really isn't. It's frustrating because it would be great if everybody could take advantage of low interest rate environment with the real estate mortgage rates where they're at right now. With real estate prices, they're rising. And, I think that for some time we've had this low interest rate environment. I would expect for the numbers to be double what they are, but yet the media can continue to now get back to touting that the housing market is leading this economy again. And we'll jump into that today. We'll jump into April new home sales. We'll talk about Case Shiller Index. We'll talk about the jobless claims, the Fed meeting from over a week ago, and what all this means to you and your real estate decisions. For you that are looking to get into the market today, or if it's 5 months from now, a year from now, we'll kind of lead you down that path. Joining me on our panel, as he does each and every week, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert, Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, CNN, and numerous others. Louis, how you doing today?
Doing grand, Ryan. How are you?
I'm doing well, Louis. So it's been about a little over a week since we talked last, so we've got kind of a lot to dive into, but not much has changed other than the fact that real estate is now back on the front burner. It was on the back burner. It was non-existent, and now it's made its way back to being on the front burner, mainly because we had April new home sales came in at 517,000 versus 510,000, so they came in a little hotter than expected, and that's all that's needed for the media to jump back on board, right? Case Shiller Home Price Index 5.0 versus an estimated 4.6. So we get a couple of reports here with real estate stuff, and all of a sudden it looks like, wow, everything is moving exactly where the Fed wanted it to. They didn't want to talk about it, but now I bet you in the next Fed meeting they're going to start talking about how it looks like real estate's heating back up.
The strength, the underlying strength of the jobs market, accelerating real estate market. Yep.
But you know what? No, we can't get too excited, Louis, because this is still a very fragile economy, and it's very data dependent. We need to see if that's gonna hold up next quarter, right? This is a monster that takes place day in and day out with them, and it's never. I don't think that they're ever gonna have enough data because we're at the point of no return. I don't really think that there's anything that can be done to fix this at all, and they know that. They know that, which is why they'll continue to talk out of both sides of their mouth, act like things are all rosy, but they realize that, and you bring up the point all the time, Louis, that, they don't want to lose but so much credibility. So at some point they make a credibility play, whether it's tightening or not. But they have started to make it seem like they're going to pull the trigger here soon. As I mentioned to you before we came on this call, that in the last Fed minutes that came out, the word patience wasn't used at all versus the last meeting's minutes that came out that was used 5 times, right? So they are giving the impression that everything is moving in the right direction. So at what point did they have to make that credibility play again. And now it's still my belief that it's not going to happen anytime soon. I think that as we move closer and closer towards these elections, I really think that it's not going to be much happening. Not saying that it won't, but I just don't think that it will. I think that they'll continue to drag things out. I think we'll continue to have the quarter after quarter bouncing back and forth, whether it's negative data then positive the next, negative data then positive the next. And it'll keep it so that it's just moving along at the pace that it's been going for over 6 years now. Want to get your take, obviously, on the April new home sales number. We also had the April existing home sales, which actually were less than expected, of 5.04 versus an estimated 5.24. Interesting to me because, okay, great, new home sales were up 1 month, but the existing home sales were down. I would expect for all this to be red hot with the low interest rates that we have. That's not the case. So I want to get your take there. Also get your take on the Fed, and I know that you have some insights on some of the Fed board members that have been speaking across the country lately.
Well, Ryan, first of all, I think that the Fed will raise rates this year, not because the data is good, not just because they said they would, but because they have to. And what they'll do is they will insist, or they will change the data to fit the narrative that the reason that they're raising rates is because the economy is doing well and they're able to raise rates, and therefore they should raise rates. And they will point to whatever data they can and come up with the narrative that the economy is doing fine. Now, if you look at the first quarter GDP, you say, well, wait a minute. It was barely positive, and the revisions will probably be negative, and the second quarter isn't looking too good. Well, they've already got a solution to that. I think it was the St. Louis Fed said, wait a minute. The first quarter wasn't that bad. If you doubly seasonally adjust and stand on your head and listen to Jimi Hendrix backward at 78 speed, it was actually 1.8 positive. So they will just change the numbers. They will come out with whatever they want to say that the economy is strengthening. And the reason I believe they want to, not only to gain credibility to say that this policy worked, they don't want to become the Bank of Japan. They don't want to be the only buyer of U.S. Treasuries, the way Bank of Japan is for the Japanese bonds. They want other people to buy the bonds. And I think because of all this de-dollarization that's going on, the United States has to be the one place that has the strong dollar, has the demand for Treasuries, because it actually pays a yield, whereas all the other countries don't pay a yield. Now, there's risks in that. They know that a strong dollar is actually deflationary. But my view is, Ryan, that the Fed ultimately only cares, or not only cares, but primarily cares about the U.S. Treasury. They're there to make sure that the dollar and the Treasury are strong, and the Treasury can continue to have demand for its bonds. The economy is secondary. If somehow they raise rates, the economy goes down, they can blame it on anything. It was unexpected. This happened. Congress didn't do his job. Russia, Ukraine, whatever they want. They don't have to take responsibility. But if demand for the U.S. Treasuries dries up, or not dries up, but kind of declines a bit, there's a bigger problem. So I think the Fed is clearly on the side of raising rates. Sure, they'll hurt the economy. That doesn't mean they won't do it. They've already got excuses lined up for why the economy won't go down. And what they'll say is, it was unexpected because let's get back to housing. Now, housing, we've always said, for the last 3 or 4 years, anytime it goes up a bit, and they claim it's the biggest number in 6 years, 7 years, yeah, those numbers 6, 7 years ago were historically the lowest ever. So when you get a slight rise, it's the law of small numbers at play here. We are still, in terms of existing home sales and new home sales, Ryan, at lows last seen, I think, for existing home sales since the year 2000. And in new home sales, we're at 1960s and 70s levels when the population was 35-40% lower. So existing home sales and new home sales are horrific. They're not good at all. They're 3 times less than what we had in 2005. So what that they went up a bit? But the narrative is, and I can give you 2 quotes here. This comes from Reuters. The upbeat report adding to housing starts data indicated that housing was gaining momentum after treading water for much of last year. Economists believe, they never say some or many, they say economists believe, housing will take the baton from a lethargic manufacturing sector and help to drive the economic growth this year. So they'll admit, well, yeah, the rest of the economy is no good. You got a lethargic manufacturing sector. Industrial production is down. Everything is down. But housing back to the rescue here. Then it says housing. Now, remember, there's three legs of their propaganda school. It's the housing market, the real estate market, and the jobs market. They claim all three are doing well. Housing is being buoyed by a strengthening jobs market. Then they add, which is encouraging young adults to set up their own households. There's no evidence of that at all. And they like to invent the concept that there's a strengthening job market. Then USA Today comes out. Rising rents will drive home buying. No, it won't. If you can't afford rent, how are you going to afford to buy a house? But, of course, they're trying to make it seem as if rising home prices and rising rents are all good, when basically your cost of shelter, Ryan, as you know, is one of your largest expenses, and that's where the inflation is. When they tell people there's no inflation, but basically most of their money is going to rent or to service their mortgage and to pay insurance on their home or to pay health insurance, and they're all up, people have less money, and now they're scratching their heads. How come the consumer isn't spending their gas savings? Because their gas savings are next to nothing compared to the increase they had to pay in rent and insurance. So housing starts, Bloomberg comes out and says that, here's a quote from Bloomberg on the housing starts. The surge in April housing starts sends a clear signal that bad weather was the root cause of weak readings in the first quarter. No, it isn't. I mean, that's the first sentence. And they use a surge, and then they're now saying, the first quarter was all weather, and now everything is just headed back towards growth. And we see this constantly. Here's another one. Student loans don't prohibit home buying. That's in CNBC. Of course they do. I mean, they're making it sound now, and you saw on the other one, economists believe that young adults are going to set up their households. They have to put out there that there's this pent-up demand out there, and it's just waiting to be unleashed. During this time, we're already getting this surge. And nothing can be further than the truth. You've got a slight increase from a bad number, and they're jumping up and down claiming that the housing market is fine and it's going to drive the economy forward.
Right.
Lies become truth if you just look at them different. They're going to change how they calculate the GDP?
Probably so.
They said that. What is that? I mean, you burn the dinner and then you say, well, I mean, if you just scrape all the stuff there, it's not really burnt.
Mm-hmm.
It's unbelievable. I mean, now you got the Fed saying, Williams, and this also ties into my theory that they are going to raise rates, and if anything bad happens, they'll blame something else. Yellen has always said that we don't prick bubbles. No, they just create them. But they love to have this out. And Williams said that Fed president in San Francisco basically said that about whether monetary policy can fix things. He said, despite the clear need to consider all potential tools to avoid a financial crisis, I'm unconvinced that monetary policy is one of them. So at the beginning of the financial crisis, which they caused, they claimed they were going to fix everything, that QE was the answer, and it was going to create a wealth effect, and they were going to create a stock market increase, and real estate prices were going to go up, and Yellen said that this would be good because then consumers would feel richer, they go out and spend money. And now they're starting to backpedal and saying, well, we really can't do much at all. So this is why I'm saying they will raise rates and then say, well, what do you want from us? We spent $4 trillion and the economy didn't pick up as much because it was unexpected. It was going along fine. And so now we have to look to Congress. Congress, why don't you institute, see, this is your new president comes in, and institute some massive infrastructure program which involves more government spending. Because, Ryan, the people on the Fed are Keynesians. But if you know Keynesian economics, they believe that the government should spend money in times of economic recession in order to be the spender of last resort.
Mm-hmm.
But monetary policy doesn't spend any money. It just manipulates interest rates and buys bonds to feed the deficit. So most of the people on the board, the Fed board, are Keynesians who really want to be congressmen spending money, and they're not in that position to do so. So basically what they're saying is that, look, we've done what we can, But because we believe in fiscal spending, we want Congress to pick up the baton and start spending the money. And if there's an issue with them having to monetize any infrastructure bonds, I'm sure the Fed would be more than happy to buy them. But I think what they want to do is they want to get out of the bond buying, the U.S. Treasury bonds, at least for now, and they want more government spending elsewhere. Because they realize that no matter what they say about it, strengthening economy, improving economy, solid, whatever word they want to use, they know it didn't work. And they don't want to get blamed for it not working. So what they want to do, in a way, is if they raise rates and things collapse, they want to be able to blame somebody. They want to keep their jobs. They want to keep the demand for the Treasury high. And again, if there is a collapse, that'd be even more demand for bonds. Because if they raise rates a bit, right, then if there becomes more demand for them, so what if rates go down a bit? They're still setting the bar higher for the U.S. Treasuries than all the other bonds out there.
Well, I do like your theory there. I could see that playing out potentially that way. Although, when things start to make too much sense, they don't, right? And so what you just laid out there is, I'm sure that they've got all those thoughts in the back of their head, that we're tired of being the ones that are looked at as the one that's controlling this disaster that's looming, right?
And they don't want to own it.
Yeah, we want somebody else to be at stake, to be in control of it. So why not push it back at Congress? It makes sense. I do think that I think that a lot of them talking on both sides of their mouth, as we talked before we came on, about that the main big concern that they have for rising interest rates would be a massive sell-off of bond holdings. So I could see that would put us into a tailspin immediately if that took place. Would you not agree there? Like, if it happens, would you agree that we should see a pretty disastrous, I would say, depressionary environment if that does take place? And I think that they're cognizant of that, and I think that's why I almost want to believe that they want to let this continue, allow for the stock market to soar higher, keeping interest rates low. I almost feel like they can claim whatever they want, but I actually feel like I know they're not supposed to have unnecessary pressures from Congress and others, but I feel like they do, and I feel like they have unnecessary pressures from the rest of the world. And I think they're taking all this into consideration. And maybe they don't want to be the one that takes the fall for this, but I think that they're just thinking that it'll just never fall, or that maybe they can continue this for another 20 years. I don't know. But,
right, Ryan, if they were to raise rates, you're talking about 2016, they only have to raise rates once, let's say in September. That's a year away.
Like a quarter, right.
Yeah.
Yeah.
That actually gives them enough breathing room between them and the other central banks. It actually shows that, and then they can play the whole pushing it out, and threatening to raise rates until after the election. Or maybe they do one more. It's not that big of a deal. And a lot of people say, the derivatives will blow up. If anyone with any sense who owns derivatives has been hearing this for the last year, they're going to raise rates, they've changed their positions.
Well,
they've re-hedged them. They've let things expire. They've entered into new agreements. It's not like they just came out of the blue and raised rates and then have a derivatives blow up. That's not going to happen. Anyone who has any sense has changed their position, knowing, because it's only people like us and others that have been saying that they won't raise rates. The vast majority of people who are managing money and are on Wall Street are fully prepared for a rate hike.
Mm-hmm.
See, it's like that's what, and the other people that don't believe it, the very large minority of people who believe that the Fed's not going to raise rates and is going to do QE4, they don't control that much money. In fact, they have less money because they've had precious metals for the last 3 or 4 years. So this idea that someone's going to be a big derivatives blow up if they just raise points a quarter of a point is not true.
Yeah, I think that a quarter point wouldn't really do much, right? Like, it's not.
Well, it would if it was just thrown out there one day overnight and they hadn't been telegraphing it for 18 months.
Yeah, well, the difference between where it's at now and then raising it a quarter, if it was,
it's already baked into the market anyway.
Correct, and because they've been signaling this for some time. So if they made a move and it was like a half a point raise or something that they weren't expecting, that would be different. Which they won't do.
No,
they won't do. Because
whether they do it in June, September, December, it doesn't matter. They're going to do it, and it's only a quarter point, and everyone's ready for it.
Yeah, at this point, I don't really think it matters. Things are just bad all around, and they
actually, Ryan, what does matter is what they say when they raise them. And of course, they're not going to say, "And we're going to raise them next meeting."
No, we're going to look at the data for the next 4 years.
Exactly. They're going to make it sound like most likely it'll be a dovish statement. It's not one and done, but they're going to do this. It's going to take years. It's going to take time, and they'll reintroduce patience for the next one.
Yeah, it's this whole data dependent thing is just becoming absurd. What data actually are they going to get? Because they can manipulate it. I mean, they can have the numbers come in wherever they want, but
Ryan, the data that they have would tell them not to raise rates. So they're going to raise rates because they keep insisting the data that they've gotten that's bad is actually good, and the data that's okay they insist is spectacular.
Well,
that means they want to raise rates no matter what.
It's perplexing to me because we were talking about before we came on the same thing with the stock market, right? It's like, okay, what does the stock market actually show? Like we were talking about Zillow, a company that's been around for 11 years and is not making any money. At what point do you say, okay, I'm pulling my money out of here because this company is going to flop, right? At what point? Well, it doesn't matter because as long as the stock price continues to go higher, then everybody believes that at some point they will turn a profit. Maybe they actually.
I don't even think they care if they make a profit. They only care if the stock goes higher.
Well, that's what I mean, though. But it's like the way that people used to look at companies, right, and valuing them and looking at what their profit margins were, and now it's none of that matters. It's a completely artificial economy all the way around. Whether it's real estate, stock, bonds, and it doesn't matter what it is. Completely 100% manipulated. Yep. And it's unfortunate because, when you get questions, and me dealing with real estate clients on a day-to-day basis, asking mortgage questions, asking real estate questions, where are interest rates going to go in the next 6 months? What are home prices going to do? And I tell them, well, the answer to this is that I don't know exactly because the Fed controls all that, right? And the only thing that we can do is kind of watch and guess based upon what's happened in the last 6 years and how they're probably going to react moving forward, because they've become pretty good at that, right, Lewis? It's like, okay, they're highly predictable at this point. And the one time they made the missteps, they try to correct it as fast as possible, so they're very careful with their language now. They realize how much of the implications of them saying the wrong things can move markets, so they don't want to do that. And I was telling you before about, basically the lost decades with Japan. I mean, I'm not saying that this is out of the realm for the United States. It may not be to the point where Japan was, but I don't know. I just don't see us coming out of it. It's something that I feel like, as you mentioned, they're going to have to start next election. It would make sense that they're going to start talking up infrastructure and jobs all over again, right? And that we need to really focus on that, and that's going to be the wave of the future. Is the technology built around the infrastructure, and there's nowhere else to go. There isn't, other than to just spend money.
Spend money and buy stocks.
push stock prices higher. The rich get richer. The middle class get pushed further down. Because as you mentioned, who's in the stock market, right? Like, everybody keeps looking. And see, this is interesting because
central banks, companies buying their own. The two biggest buyers are central banks and companies buying back their own shares.
Right.
And then hedge funds. And the average Joe is not sitting there like he was in 1999 with an E-Trade account flipping internet stocks.
And even if he is, Lewis, he's playing with a little bit of money there, it's not enough for him to cash out. You know what I mean? I mean, you hear occasionally.
Well, you know what the danger is, Ryan? Those people have more margin than ever before. Even though, this is not a broad-based real estate market where so many people are buying houses, selling houses, so many people are buying and selling stocks. But the few individuals that are buying shares have the margin to the hilt. Mm-hmm. And I guess they're just coattail riding off if companies are going to buy back their own shares, and if central banks are invested in the equity markets, why not? And if they're going to keep pumping out there that everything is fine and is getting better, even though if you look at the rate of the stock market increase to the tepid economy, it's outrageous. And that can, people have said, well, that happens sometimes, but not for 4 years. There's times when there's expectations the economy's going to get better, so the stock market gets ahead of itself, and there's times where the stock market's lower when the economy's doing well. There's readjustment periods, but the stock market has gone straight up for 4 years, and the economy's been flatlining and decelerating for 4 years.
Mm-hmm.
So that should tell you something, that there's a reason the stock market's going up. It's not based on the underlying economy. It's based on interest rates, nowhere else to go, and who the market participants are, which are companies doing share buybacks and central banks putting money in the market.
Right, and don't even worry about any of that stuff anyway, Louis. Just listen to what the Fed tells you to do, and you'll be okay. Just everything's fine. They're going to raise rates sometime in the near future, within the next 3 years.
I actually think they'll raise them this year. Every one of them, from hawk to dove, has said they're going to raise rates this year.
Well, I think that while I would like to think that they would do something like that, it's just I continue to take the path of you need to prove to me, because you haven't proved much to me over the last 6 years, right?
Well, that's true, but the thing is, they've said it, they'll do it. And the only reason they won't do it is they're hoping probably they don't have to if there's some external event that makes it impossible for them to raise it.
Yeah,
otherwise they're going to do it.
But as I mentioned to you, I don't feel like anything bad would happen on Obama's time.
No, I'm talking about things you can't control, natural disasters, terrorist attacks, stuff like that.
Well, I'm talking about the Fed and making a move on interest rates. I'm saying that has implications for the presidency. If there was a massive bond sell-off and all of a sudden mortgage rates went higher and everything else started hitting the fan,
that could be played to anyone's political advantage.
It could.
I mean, Elizabeth Warren she can complain all she wants about banks and so on, and that's why she should be elected. Bernie Sanders can do the same. Clinton is skilled at talking out of both sides of her mouth. So for the Democrats, it doesn't matter. For the Republicans, that helps the Democrats, and for the Republicans, it could be a help too. They can say, "Look at the Obama economy." So I don't really think what the Fed does in the summer or fall of 2015 is going to influence the 2016 election. That's why they'll do it now and not later. They'll talk about doing it later.
Well,
and that's not anything. I agree with you, Ryan. You say nothing bad is going to happen on Obama's time. A quarter-point interest rate is nothing bad.
I guess it depends on who's looking at it.
How bad is it going to be if they raise rates?
Well, it's not going to necessarily be bad, other than the people that can't already afford their bills. It's going to get a little bit more difficult. Because loan rates are going to go slightly higher. I mean, it's not
slightly
enough to
higher.
maybe. Yeah, I mean, but
So you raise them in the fall, Ryan, when the home season buying is kind of over anyway.
But my thing is okay. So that tips, shows people, okay, so they are serious. They're going to do it. So what's their next move? Are they going to choose to raise again in 2016, or are they just going to hold off for two or three?
What they want to do is quote normalize things. They want out, so they do another
quarter point's not normalizing anything, though.
Of course it's not. Normalizing is 5 or 6%. They're not going anywhere near that. We've talked about this. They can't afford to raise rates because the government can't afford to pay the interest. However, if they boost up rates just a bit, Ryan, and they attract more foreign capital, rates will the excess demand will drive the rate back down anyway. And this way, they gain demand, which means the Treasury's happy because now they can continue to sell the bonds, and the rates won't go that much higher. In fact, because they've raised the rates and more people buy the bonds, the rates will start to come back down again. That's what they're doing, Ryan. It's about protecting the Treasury. They care less about the economy. Everything's done is to protect the dollar, especially with all this de-dollarization going on.
Yeah, well, they've proven they could care less about the economy. I mean,
of course they do. They'll just invent that the labor market. They can't even do anything about it anyway, even if they wanted to.
No.
That's why they invent the Bureau of Labor Statistics invents the birth-death rate model, claims that businesses are being developed, being initiated, that there's new businesses out there, and that they're creating jobs with no evidence that there are new businesses being set up and created with new jobs. That's why that number, they place so much, that's the most important number. That's the one they can make up the most. And some people say, oh, people who say that's a conspiracy theory. No, it's not a conspiracy theory. It's not even a conspiracy fact. It's just that they themselves cannot prove that these jobs are actually created. Which is different.
And they don't have to.
They don't have to, which is different than some other numbers where they actually produce the data and they say, here's how many people file for bankruptcy. You can't make those numbers up. Those are the exact number of files. You can falsify them, but that's different. The way they do the non-farm payroll is with assumptions. They just make it up. And it's not a conspiracy theory to say it can even be done without malintent. They just got it wrong. They're just using an assumption and a model that these new businesses are being created and they're creating jobs, but they're not. Is that possible? Of course it is. Now, is there a political reason for them to do it? Sure there is. They'd want to err on the side that more businesses are being created, so their assumption says there's more jobs being created. But they can't prove more jobs are being created.
No, they definitely can't prove that more jobs are being created. And you and I both know, and I talk about doing the eye test all day, and I know how many people I talk to on a weekly basis, and they're telling me about how, you know, their son or daughter is still looking for a job 2 or 3 years later. They're, you know, they got student loan debt up to their eyeballs.
But that's not preventing them from buying a house.
The
USA Today says
buying a house is the furthest thing from their mind. I can tell you that. You know what I mean?
Of course it is. Now, but if you ask them in a survey, do you want to buy a house?
Of course they're going to say yes in the next 10 years.
You ask a drunkard when he's in the ditch, you know, do you want to be sober? He says, yeah. Sure, he wants to be, but he doesn't have the wherewithal to become sober.
Well, it's, yeah.
A lot of work.
If you ask a kid that gets out of college, does he want to be a millionaire, what is he going to tell you? Of course. But it doesn't mean it's going to happen.
He wants to be Elmer J. Fudd, a mansion and a yacht he wants to have.
And you and I both know that, I mean, anybody that's out there that wants to do those things has the potential to be able to do it. It's not the easiest environment to do it unless you have friends that are buddies with the Fed, big banks, hedge funds, or one of the like. You know what I mean? I mean, if you got friends,
or you have an Ivy League degree and you can get into J.P. Morgan, Morgan Stanley, Goldman Sachs.
Yeah, but you know those are few and far between, and you know to think that real estate is driving the economy is crazy. There's not the jobs. There's not wage growth. To even support where a lot of the valuations are going on the real estate right now. But what it is a lot of people of rich that have excess capital that are just buying up real estate. I mean, that's
right. Do you have the Case Shiller numbers in front of you?
Yeah, Case Shiller was 5.0 versus 4.6.
Right, but do you have the 20-city breakdown?
Let me see. I might be able to pull that.
I have in my head some of it while you're pulling it. First of all, San Francisco and Denver were over 10%. So a good part of that increase is San Francisco. And we know San Francisco is in a ridiculous bubble. San Francisco's up. I mean, the average home in San Francisco is over $1 million. Average median home. That's ridiculous. And the only reason people pay it's not because salaries in San Francisco are that high. It's all stock option money and foreign money. And that's not sustainable. And San Francisco has always been in the United States almost like a foreign country. Ever since the gold rush. It's a different type of economy. It's a different type of person who lives there. It's a different social environment. It's like New Orleans. Those two cities have very little to do with the rest of the United States in terms of their economies. I mean, New Orleans is on a civil law jurisdiction. It's 100% different than the common law jurisdiction that the rest of the country is under. San Francisco is a boom-bust environment. So you can't even count that city. I don't know what's going on in Denver, but Denver is doing quite well. But then if you look at other cities, if you pulled it up yet, I remember Cleveland is down 1.2%. Now, there's far more Clevelands in the United States, Detroit's, Newark's, than there are San Francisco's. Gary, Indiana. I mean, there are tons of cities that are not doing well, where home prices are not going up. But yet, the Case Shiller Index picks 20 cities, and most of them are your more glamorous cities. You got New York, Boston, San Francisco. What are some of the others? Denver.
Oh, yeah, Denver. Let's see here. It was the ones that led were, I believe, San Francisco and Denver increasing by 10.3% and 10%. Double-digit gain with San Francisco, first since July 2014. Cleveland, largest slide, falling 1.2% from March. This one only gives a breakdown of just the top winners and losers. I can't find the full list there.
Yeah, but if you look at your top cities in the United States by population, he doesn't have those in there.
No.
Well, he's got some of them, but he's got New York City, Los Angeles, Chicago. But then, some of the cities that are not doing well, like Gary, Indiana, he doesn't have that one in there. He doesn't have Detroit. Doesn't have. He does have Cleveland. Is Baltimore in there? Is Memphis in there?
No.
No, he's got Las Vegas in there. He probably wishes he didn't, because that one had gone up, but that one hasn't come back. You got Milwaukee in there. These are cities that are the forgotten cities. There's far more of those cities than there are of the top cities. So it looks like, if you look at the Case Shiller, home prices are right. St. Louis in there?
Well, look, the composite 10 home price index is Boston, Chicago, Denver, Las Vegas, Los Angeles, Miami, New York, San Diego, San Francisco, Washington, D.C. Why would you even put all those together?
San Diego, Washington, D.C., all cities that, of course, are going up. Is Newark, New Jersey in there? Is Camden in there? Fort Wayne, Indiana in there?
Composite 20.
Madison,
Atlanta,
Wisconsin?
Charlotte, Cleveland. Atlanta, Charlotte, Cleveland, Dallas, Detroit, Minneapolis, Phoenix, Portland, Seattle, and Tampa.
Yeah, all of those are mostly desirable places to live. Is Buffalo in there? I mean, it's the city. I'm not denigrating these other cities. The point is, these other cities are not doing well, and they're not included in the index.
Oh yeah, because they would bring the numbers way down.
Of course they would. I mean,
can't do that.
Cleveland is basically your example, and it's the outlier. It's only 1 out of the 20. But there's far more Clevelands than there are San Franciscos in the United States.
And they threw the Cleveland in there just to say that, hey, there is the one there.
Yeah. Well, they'll probably add Detroit now that, home prices will double from $85, to $170.
Detroit's in there now. The two that are in there, it was Atlanta, Charlotte, Cleveland, Dallas, Detroit, Minneapolis, Phoenix, Portland, Seattle, and Tampa, in addition to the other 10 major cities that I
but
gave
look
you
at
before.
Portland, Seattle. What kind of cities are those? Again, very rich cities.
Yeah.
Minneapolis, they're not putting in where the majority of the people are hurting and are not doing well.
Mm-hmm. Yeah, I mean, they're not putting in areas where the jobs are basically non-existent, right? And I think that this is obviously media is driven by, media companies that are in major metropolitan areas. So they're
absolutely, and everything's fine there. No one's denying that San Francisco isn't doing well, or New York City, or Boston, Los Angeles. But what about these other cities?
We know that they're not booming like they are here, I guess booming is different for every individual what they would consider doing really well or not. But most people, we were talking earlier about the amount of people out there and like the existing home sales and new home sales and the levels they're at, and you have to right off the bat remember that about 25% of Americans still are underwater. Like it's even with the appreciation that we've had in a lot of these areas, from when people bought back in like 05 and 06, they're still underwater. If they still have their house, if they haven't been foreclosed upon, if they didn't have to short sale their home currently, which now they're forced to wait, 3+ years before they can buy again. And then that's not saying that they even got a job after that because they may have lost their job. Or, there's so many factors that play into this. It's not just as simple as just wanting to buy a house. And I think many people
and there being
find that
low
out.
interest rates.
Well, yeah. If it was just as simple as everybody showing up to the bank or saying, you know what, the rents are high, I'm going to go buy, and everybody just went down to their local bank and filled out some paperwork and they got a mortgage, if it was that easy, I'm pretty sure everybody would do it. I'm pretty sure that the numbers that we see here would be double or triple. And they're
you know what they're not including also, Ryan? The cost of buying a house. The taxes have gone up with the prices of the houses. So that adds to your mortgage plus your taxes. All of a sudden, it's a much bigger number.
Well, it's interesting. Taxes have gone up, and if you're living in a major metropolitan area with condos, the condo fees have gone up astronomically. Yep. Homeowners association dues have gone up, but no, there's no inflation, Louis. There's none.
Nope.
The cost of doing business is still the same. It's relatively cheap. We got cheap gas prices, remember?
And they've gone up 30-40% in the last 3 months.
They have, but you know what? They were pocketing all the savings from the previous 3 or 4 months so they can afford to pay their higher condo dues. I mean, this is where we're at. It's like to try to justify everything, but the reality is things are getting much more expensive. They're getting much more expensive. Food, I mean, food, energy, all of it. It's getting
and the Fed's trying to make them even more expensive. They want to get that CPI up to 2%.
Right, but people's wages are not growing. They're not.
So, and why would they? If company sales aren't growing, just because their stock price is growing, doesn't mean they can afford to pay their workers more. In fact, if they paid their workers more, their stock prices might take a hit because their profits would go down. And the only reason their profits are higher per share is because they buy back their shares.
Well, and they're going to continue to probably outsource as much as possible to eliminate positions, right? They're
go part-time with a lot of positions.
Right. They don't want to have to pay benefits for as minimal amount of people as possible. So
go to your grocery store, go to Home Depot, Lowe's, all the big box stores. Yeah, they're hiring. They all say part-time only. Part-time on weekends.
Yeah, you'll hire 100 part-time employees versus hiring, 50 full-time ones.
I've seen people on weekends in Lowe's that also work in Home Depot during the weekend. It's ridiculous. And they're trying, and you know what? That looks like job creation. That's 2 jobs. But it's one person, and it's 2 jobs where the person isn't making enough to the type of money he wants to make. And I also read that the average age of a minimum wage worker is 35. It should be 19. Okay. Minimum wage jobs should be entry level. But the reason it's 35 is because you have a lot of older workers going back to the workforce or taking those jobs because they have to.
Yeah, because as I mentioned, we talked about this on a past episode that the seniors have been living off of their nest egg, and a lot of them scared to keep money invested in the stock market for the fear of losing it. Right? They've just kind of
they can't live off the interest
over the years. Yeah, they can't live off the interest. They used to be able to put it in CDs and make 3 or 4% a year, which was typically enough to cover some of their expenses. Now
there's nothing.
They're like, I got.
You're eating away at principal. If you have $50,000 saved for your retirement, 15 years ago you might make $5,000 a year off of that. Now you make nothing. So at the end of the year, you have to take, to live, you take out $10,000, $15,000. Now you're down to $35,000. Do that for a couple of years, you're out of money.
And then you have to go back to work.
Or go back to work when you see that happening.
Well, of course you do. And now they're taking up jobs of the people that are getting out of school and sitting home on the couch thinking that they're supposed to get a $50,000 or $60,000 a year job.
Right, that they're too good for those jobs. Or they're going to go back to school and not take those jobs. So what happens is if you go into the big box stores and the grocery stores, most of the workers are older.
Mm-hmm.
When I was a young lad, 15, 16, 20 years old, grocery stores, big box, all those stores were swarming with teenagers and people in their early 20s. They're working their way through college, working their way to go to college, and the only older people there were the managers.
Mm-hmm.
It's not that way now.
It's not at all. It's
that's where you learn your skills as a young job entrant.
Mm-hmm.
You deal with customers, you deal with the cash registers, you deal with stock. You learn to interact in a work environment. Those are good jobs.
Well, and see, I'm convinced that many people, most of them haven't even had a job ever, right?
No, and then they expect to go into a corporate environment, having never had a job, and they expect that the company is supposed to give them some type of personal satisfaction. That's not what a job is. You're supposed to do what the company asks you to do. They're not supposed to give you. See, now in Silicon Valley, the people can ask for that type of thing, lifestyle. They can ask for work at home. They can ask for a whole bunch of amenities because companies have a lot of money and there's a shortage of people to work out in those areas. But good luck with the rest of the country trying to get a job where they satisfy your personal needs.
I'd say they're definitely few and far between. This is not, this problem is not going away either. Like, it's not all of a sudden like we're going to, next year we're going to turn the corner and then all these jobs are going to open up. And
what's going to happen, Ryan, is the ones in Silicon Valley are going to go away, and then all those people that have been pampered and given $6,000 apartments, free bus rides to the campus where they work, that's all going to go away, and they're going to be sitting in their apartments wondering how they're going to pay $6,500 a month rent next month. Well, when their company that had just developed this great app that no one buys, but had a lot of users, went out of business.
Well, it's just like, we had the .com, bust.
It's exactly the same thing. In San Francisco, after the .com bubble, real estate prices cratered.
Right. Well, it's going to be the same thing. This might be called the startup bust, right? Because it's like everybody out there thinks that they can just create an app or some sort of technology company and they're going to make it rich.
Well, did you see the Snapchat guy? He's 24 years old. He's got some sense. Probably a brilliant guy, invented the Snapchat concept. Mm-hmm. Not a lot of users. I don't think the company makes any money. I think it's a startup. It doesn't matter. The point is, he said there's a bubble and it's going to burst soon.
Mm-hmm.
Of course he knows that. His wisdom of 24 years tells him, wait a minute. All these people are getting jobs, getting paid a lot of money, and the companies aren't making any money, so where are they getting the money from? Well, they're getting it from the stock market.
It's one of those things, that's what I always joke about. Like, we talk about if you or I try to start a business, and it's like, you're required to make money or you go out of business. But it's just a fantasy world that everybody else lives in today. It literally, there's no consequences. There's none. And especially if you have buddies that are running other startups, because they can bail you out and you can
right.
pivot and go blow another $1 billion
right.
with a new startup.
It would be hard for us to. You cannot go to a venture capitalist and tell them, here's your business, here's how many widgets you're going to sell, and you're going to get a return of 10% a year. They look at you like you have three heads, because they expect to take your company public and make 2,000% gain, which they're not going to make if you just have some manufacturing thing that's going to produce widgets. They want all the companies today that do well have no assets. They're thin air companies. Uber doesn't own cars, doesn't have any customers. These are the companies that do the best. The companies that have no assets. Thin air companies that they can value basically all the way into thin air.
Well, they do. They definitely do.
Well, that's what it is.
Yeah. Because you can't put a number on it, right?
Right. And the sky's the limit. Of course it is.
Well, it's going to be interesting to see how things evolve over the coming years. And well, I think the more important thing is that we will obviously you got your prediction that by the end of the year the Fed will at least make their probably 25 basis points raise in interest rates.
Yep. So other than some catastrophic thing that comes in out of the blue.
Yeah, which very well could happen. I mean,
if that happens, then they wouldn't raise rates.
Well, we could have another sideshow, right? We talk about it all the time. It's every 3 months they tend to pop their head back up. So there will be another one come middle or end of summer. So we'll have to keep our eyes on that as well. Well,
you know what the new sideshow is, which we should talk about next week, is the soccer scandal. The DOJ is vigorously prosecuting that one. Soccer is very important to the national economy. They won't prosecute the banks, but you mess up kicking the can down the road the wrong way, you're in big trouble.
Yeah, they won't prosecute anybody for manipulating like the Forex markets, right?
You just pay a fine. You don't need to be made an example of.
Yeah, come back tomorrow and business as usual.
Mess with the game of soccer that no one in America watches, and they're all over you.
Let's touch on that next week. Thanks for coming on, Louis. If you wouldn't mind, give our listeners your so they can check out your weekly post.
Sure. Thanks, Ryan. Smallgold.com, SMAULGLD.com. Please check it out. Analysis on the Fed, gold, silver, and real estate. Smallgold.com. Thanks, everyone. Thanks, Ryan.
Thanks, guys, for tuning in. We'll be back again next week. If you have any questions, go to the website, realestate360live.com. On the right-hand side, there's an Ask a Question button. Also, you can download, subscribe, share the podcast on iTunes. If you go to the iTunes store, you can search bar Real Estate 360. Until next time, guys. Take care.